Hey, Kim, we went ahead and live, and the reason we did without the intro is for whatever reason, my computer wouldn't do the intros. I don't know if your computer can do it.
So give me a second. I just got in and I got to get familiar. You first off, welcome to IBM TV, and give us a minute. We're usually in more control.
Well, our director's still on Med Friday. And
Okay.
Gwen, I don't know where Gwen's at. So,
and we got John Power on. So give me a minute. Just bear with me a second. Let me see. Did you get your own, or are you doing IBM TV?
I'm just going to do our regular intro.
All righty.
Okay, so go ahead and just hit the regular intro. The airplane.
Here's takeoff from the airplane.
Right, there we go. So if you can hit it, mine won't hit it.
Just give me a second.
I'm panicking.
I can do Walter Football. I'm just kidding. Here we go.
Walter Football is a good intro. Oh, well, good afternoon, everybody in America. Good evening to people in India, and obviously good night to our friends in Australia, Malaysia, and Hong Kong, who I think Rakesh already went to sleep. He was actually sleeping on one of our shows out of Hong Kong. It was kind of funny. So welcome to IBM TV. This is Financial Friday. For those who are going to be joining us from our Med Center, I know our medical show, Dr. Toole is on again, and they'll eventually morph over here, but it looks like they're having an exciting conversation on Med Friday. So with it today on Financial Friday, we have Kim Calhoun, which you all know from IBM TV, John Power, a CPA from Bismarck, North Dakota, and from, I guess, Atlanta, Georgia, Professor Beckett. Are you an Atlanta professor?
I'm actually Las Vegas resident, but I'm stuck due to COVID-19 in Dallas right now.
No!
Oh, okay. All right. Stuck in Dallas is Professor Beckett Cantley. Professor Cantley, can you tell us a little bit about who you are, where you're from, and what you do?
Okay, so I've been practicing law for 20 plus years in the tax area, tax, high-end estate planning, that kind of stuff, corporate structuring. And then I've also been a full-time law professor for most of that time, teaching for various law schools across the country, tenure track here and there, tenure at one spot, and writing and speaking a lot on particular issues that I think are out there where people are doing things a little crazy or could be done a little better, and try to feed some food for thought for the IRS and for practitioners.
Mm-hmm.
Oh, can I have a question about what kind of things are you talking about? Can you give an example?
Well, right now we're publishing two different articles in tax notes. One's coming out this coming week. Another one will be a few weeks down the road on the settlement initiatives for captive insurance and for conservation easements that have been syndicated. A lot of those, there are plenty of good captive insurance programs, and there are plenty of good conservation easements done, but there were some that are a little bit more aggressive than others, and there's particulars where I've published over the last 10 years what might happen, and a lot of it seems to have come to pass, so I feel pretty good about that.
Mm-hmm. Can you tell us a little bit about captive insurance companies for our viewers? Tell them what is a captive. From what I understand, they're used worldwide, Bermuda being a big reinsurance center. Tell our viewers a little bit about the captive insurance company. What is it?
Okay, well, captive insurance it's not quite self-insurance, but it does have a system is that you own, or affiliates own the insurance company that's set up, and you as the insured / business risk distributes some of your risks. Usually they're things that are not normally insurable. by a traditional carrier, or have a really high potential dollar hit if they do come true. And so, it's either very expensive or impossible to get insurance for what you're trying to do. A lot of it popped up after 9/11, when the world depleted a huge amount of their insurance reserves, to pay out for issues related to terrorism and things like that. And so people started setting up programs in the United States and around the world, taking advantage of either the incentive that is created by Section 831B of the code, or a lot of big companies and a lot of big people, big players who needed just regular captive insurance, needed to get some risks done and pool their own risks, but which didn't need the deduction or were too big for the deduction, just set them up for risk distribution. Risk distribution.
Yeah, so you've written a lot on captives. When did you start writing and working in the captive area, Professor?
Well, I haven't spent a lot of time working, creating captives or something like that. What I tend to do is, advise companies and CPA groups and family offices and whatnot on what investors, on what's going on, where the trapdoors are, and how to get out of trouble if they're already in it. I like to kind of predict where the IRS may go, or where I think they should go, and see if it comes to pass. And if I predicted correctly, then usually my advice tends to be worth something in the legal market. So that's kind of my way of doing business. I started doing that around 2010. My first article, I think, published in 2011, 2012 on it, a law review article, and I published, 10, 20 articles on it since then.
Yeah, our CPA friend John Parrott told us at one of our shows, he goes, there's one line in the Internal Revenue Code that income is from all sources derived, and then the rest of the 3,000 pages are about how you get tax deductions and credits. I thought that was pretty good, John. So here's the important part. What are the tax benefits of the captive insurance program? What drives the tax benefits?
Okay, so when we're talking about that, we're talking about Section 831B, which is for small captives. We're excluding the large captives that are done by, say, UPS to insure their packages or something along those lines, where you have, a huge amalgamation of small risks, put into a program to kind of disperse those risks across a bunch of different players. Instead of that, we're talking about smaller players who have a small business and typically, and they have a cap on how much of a deduction you can take for your insurance. What they do is they set up a separate captive insurance company. It could be offshore. It could be in the United States. There's a lot of states that have really good captive laws. And I've worked with a lot of them and spoken to a lot of them. Their groups. Go ahead.
Just some interference.
Yeah, we just had some interference. But since we know there's a tax benefit, what problems does the IRS have with these captives? What's the problem?
Let me finish up on the tax benefit real quick. When you pay your premium, you can elect 831B up to a certain amount, just over a couple $1 million, and you have a deduction for the premium payment, but you do not have income hit on the captive side. So it becomes kind of a deferral, and when you take the money out, you get it out at capital gains rates. So that's benefit. What was the second question? I'm sorry.
Oh, what is the problem the IRS has with this? I mean, I remember when
the IRS has a lot of problems. Okay, so we had some greedier players out there who set up programs that were based on very high actuary reports for purposes of determining the risks they were insuring, so you could pay a much larger premium, and then was probably justifiable. So a lot of these people were insuring, terrorism risk for small business, things like that, and then they take all those different deductible premiums and they pool them for risk distribution amongst a whole series of other businesses, and of course, almost none ever paid out. So the IRS is like, well, how can you justify this large deduction and this deferral if it's not really insurance, because you're not trying to insure a real risk, or it's an aggressive actuary assessment of what the value of that insurance is, such that the deduction is too big. I mean, those are two of several things that the IRS has problems with them.
Right. Okay. So, what sort of enforcement mechanisms does the IRS have against these what looks to me abusive tax avoidance transactions?
Okay, so what they did was they kind of used the same model they used against the tax shelters of the 2000s, the early first decade of 2000s, by going after kind of the bigger players, finding out through getting some regular audits, turn into forensic audits, and then try to drill down as to who the players are and who the common players are. And once they got that, they kind of market spiderweb it out, and they figured out to go after the big risk pools, which are programs where they pool a bunch of small businesses together under one kind of promoter's storefront, and almost nobody ever pays any claims out. So by doing that, they were able to kind of isolate big pockets of these folks. They then turned it into a reportable transaction, which means everyone had to file. Everyone who was a material advisor, someone who actually earned more than a certain amount of money, advising people on doing a captive, had to report to the government that they did, and all the people that were participants had to do the same thing. So the government had a huge, inflow of both knowing where the big players are and everybody self-reporting that they'd done something.
Right.
So then they went after them.
Right. Okay. So the thing is, if I set up a captive, which I did years ago, and I put in risk of a pandemic, and I funded it, the IRS would shut it down because that risk didn't pay any claims for many years, right?
Yeah. Well, they would challenge your deductions, and they have done a really good job of doing that.
Right.
And they challenge them based on several things, but the easiest one is the actuarial risk, being overassessed, so that your deduction is way bigger than it should be.
Right.
Have you ever had a situation or seen a situation where the IRS or maybe one of the Department of Revenues were actually not really being appropriate or in their reviews like that on those kind of items?
Yeah, there are people who did these kind of programs who pretty, I'd say much more balanced. And had, we're trying very hard not to be too aggressive, and they've kind of got caught in the same dragnet with the people that were being super aggressive. Unfortunately, because of the reportable transaction thing and the material advisor thing, and that's unfortunate because captive insurance has actually turned out to be something that is paying off now. Business interruption insurance was considered a very remote risk until COVID-19. Right. Now all of a sudden there's a lot of claims being paid out, and it looks a whole lot more for a lot of cases like it's real insurance. And the actuarial tables may not have been as abused in certain cases. This has nothing to do with the terrorism insurance, of course, that we're talking about, but it does have a lot to do with business interruption. And I think that the IRS has painted, while they're accurate that there were a lot of people doing some very abusive things, they have painted the brush so broadly, as usual, when they do something as a reportable transaction, that a lot of people are having to spend a whole lot of money proving that they're doing the right thing when they actually have claims now.
Right. Yeah. Well, that's what I was looking at, because I was going, well,
how do you prove when an IRS has, and I want to get to John because I don't want to be rude. He's here, but John is been part of our panel, and I want him to introduce himself. But let's do that first. I do have a big question though. But John, tell everybody who you are, where you're from, even though you've been on here before. Share everybody.
We have new viewers all the time. So John, tell us a little about who you are, where you're from, what you do.
Sure. John Power, I'm a CPA and certified tax strategist in Bismarck, North Dakota, as you said. Big share of my practice deals with tax planning, advanced tax planning for closely held businesses and their owners, real estate investors who are selling, significant property and things like that. So that's the biggest focus of my practice.
Okay. Yeah. So Professor Cantley, are these IRS enforcement actions are they going to force some of these programs to shut down these captives?
Yeah, they already have. I mean, they're not going to shut everybody down, obviously, but there were certain players that just the risk, both from being, IRS pressures as well as class action litigators and others just became overwhelming, and they shut the programs down. Some of them did it right away. Others are holding on, and some are fighting really hard. I mean, they're working really aggressively to try and improve their positions, and maybe they will. I mean, it's not everything is bad in the captive insurance.
Right. Well,
there were certain people that it got to be where everybody everywhere was trying to do a captive, regardless of what what the risks were that they were insuring.
Right. So does CPAs and financial professionals have anything to worry about right now if they recommend setting up a captive for their clients?
Well, you'd really have to focus hard on what the risks are and make sure your actuarial reports are fair. And where you'd have to have things that you can't just really commercially insure cheaply, and you'd have to have things that you have a history of having a potential claim or loss from, and then insure those things with the right level of premium, so that when there's claims, they tend to do what insurance companies normally do and have a payout and there's not a giant pool of reserve that's accumulated over a long period of time. If you could do that, it'd be fine. It's in this environment, it's so tough because everything looks bad to the IRS right now. I mean, you have to self-report that you've done this, and then the IRS comes in and causes a whole bunch of you have to spend a whole lot of money on compliance.
Mm-hmm. Right. So would it be right now? Would it be safe to set up a captive in this type of environment?
Like I said, you can, but it really needs to be proved up. I would, nobody should consider this to be something where you're going to put about a whole bunch of money away and get a big deduction and not pay claims. If that's what you're looking for, then no, it's not safe at all. If instead you're insuring real risks and you're going to have claims and there's a need for it, you just have to understand that you're going to have to go spend a little bit more money right now on compliance.
Right.
Because IRS will probably, look at you or make you spend a bunch of money completing a compliance file in case they do.
Mm-hmm. All right. So a captive is still viable, would you say? In other words,
yeah, sure.
Right.
It's still in the code. It still need,
I understand it's still in the Internal Revenue Code, but what bothers me is the 419 AF6. It sits in the Internal Revenue Code, but the promoters lost every case, not just one case, but every one of them. So they got flattened. So just because it's in the Internal Revenue Code doesn't mean that you're going to be hit with all sorts of problems, which happened with all the 419 AF6 cases.
Yeah, no, that's true. Yeah, the welfare benefit plans did get smacked really hard. So did the 412Is, right?
Yes, they did. I'm totally familiar with that. Okay, but this dog defended every one successful, but we had no swing.
Oh, good! Congratulations, that's great.
Hey, Beckett, I won every one of them, and
that's
one of them took 9 years. I said I don't care, but here's the funny thing about that. And I don't know if you experience. Every time I got my audit notice, because I go through the code really intensely, I noticed that they kind of spoke. In other words, they put in things in the audit notice that wasn't part of the code and regs. So I would have to go back and recite them and help them. So I always help my friends. I call them my friends at the Internal Revenue Service because I understand they're just doing their job. They're trying to keep things compliant. But that was. Pardon? Well, my oldest case actually was 9 years. It was settled a couple of
but they keep things compliant by lying.
No. See, the problem they send the audit notice with all these things, the laws, this and this. Okay, right. The only problem is I go back and I read the law to see if it matched.
I do too.
The weird thing is it didn't. So I would go back and said, "This is what you say the law is, but this is what the law actually says." So it's kind of a total different.
Is this common practice?
I don't know, but I'll tell you on every one of them, Beckett, and I handled about a dozen of them. Every one of them, they said the law wrong. Every one of them. And I was going like, guys, can't you just cite it right? Because it's copy and paste. This isn't hard, but they did. Yeah. But anyway, the thing is, I find
captains on that. That's awesome.
Well, I find the thing is that then they eliminated their audit programs.
I just want to know, when they lie like that and they falsify statements and things like that, do they get in trouble? Can they go to jail just like they try to make taxpayers go to jail?
That's a very interesting question. We never
I'm just
really
curious.
we never really went into that particular issue of what I
I'm
call
just curious. Can that happen?
statement of the law. But see, you would do that in court if we
That's
ever.
overreach, and that's misuse and abuse.
I only had to send them to tax court once it got bounced and got settled. So it was kind of like, and remember, I'm representing my client, and the way I worked with the IRS, I always was nice to them. So I always got good results. Some people are very adversarial. I just wasn't. I was going, no need, except if we go to court, then I'll be adversarial. But captives were always, I was fascinating with the whole captive idea, and I thought it was a great concept. Then, of course, they put some issues on. The other concept I'm interested in, and I think our viewers would be, is conservation easements. Can you tell us about the targeted syndicated conservation easements? What are they, and what is this initiative in that world?
Okay, so this is it's similar in what the IRS doesn't like, but a completely different structure. You had groups that were going around and locating pieces of property that the person who owns it is willing to have a conservation easement placed over the entire thing, so there's no development on it, nothing like that. It's preserved for its beauty or its wildlife or what have you. Any one of the reasons that are provided, that are allowed for in the charitable provisions, and they would go out and they'd hold the property for a year, and then they would get investors who would come in and buy a piece of an LLC that would then, purchase the LLC that holds the property. Mm-hmm. They would be able to tack their basis, tack their holding period, over so that they've held it more than a year. And then with that, they would be able to make use of the special provisions for conservation easements that allow a higher charitable deduction. Right. And they would place the conservation easement on it through the LLC, and then the benefits of that with a big, large charitable deduction would flow through the individuals. Now, all of that is absolutely fine mechanically. There is nothing wrong.
Right. I was following it. I thought it was pretty cool. I didn't know that.
Yeah, nothing wrong with that mechanically. The only the places where they run into trouble are once again an over aggressive valuation of what the easement is worth. Yeah. And now this is one of those things that is, beauty's in the eye of the beholder. They have some very good appraisers out there who have positions that I think are probably very, very mainstream. But the IRS really, really hates these things because they're becoming so popular. And where I used to teach, ground zero for this was in Georgia, was in the Atlanta area, and that's where a whole ton of these came out from. Right. And so they're really out of trouble. One with the size of the valuation, and the other was there were just some hokey, I would just call it bad paperwork things that people did that happened to trip up and run into trouble with the actual terms of what a conservation requires. For example, they would allow the property some of the property to be built on, or here or there, or the easement to move its lines or what have you, just things that the IRS was able to kind of nitpick in and on a particular case. But that was not something that's broad-based. That's just, easement by easement. Those are where a lot of the cases are going right now. There's a ton of cases in the conservation area.
I don't work in the area, so I don't follow it. So the thing is, they actually syndicated this. This is what I find fascinating. They basically syndicated tax deductions. Is that what was going on?
Well, you can do that. I mean, it's just like anything else. You're investing. It's just like if you invest in something that has, Section 8 housing or whatever. You know what I mean? There oil and gas credits. I mean, there's ways of you going into an LLC and getting a partial benefit, and that's what they were doing. Because a piece of property may be very valuable. There are very few people that are going to just buy the whole property. So they take what they can do for the year and get the investment, and they're doing something in their minds that and under the code that's beneficial for society. Well, you're preserving a piece of property for a specific purpose that's public use. Mm-hmm. And there's nothing wrong with any of that. It's really, in fact, the problem was they just proliferated so thoroughly. Everybody and their brother was looking at them that I think the IRS needed to try and make people aware that some of these things are way too aggressive.
Right. So were they very similar to what they call cell captives? And in other words, where they syndicated these cell captives out? Did they do the same thing in conservation easements? Was that kind of the same thing?
Yeah, you're talking about a cell captive, of course, can just be one of the ways the states organize their captive program, so that you can have what's traditionally thought of as a captive, and it's just one cell in a master group. That's a little different organization than this. This is actually where they have one LLC that holds the property, and a bunch of micro investors get in and total up, let's say, the $10 million of the property's original purchase price or what have you, and then they take the deduction because they estimate that the actual value of the property, for all kinds of reasons, its highest and best use, are 4 to 10 times higher than that.
Mm-hmm.
And so, which in certain circumstances may be the case, but in others it isn't. And the IRS wanted to make sure that everybody kind of knew that it wasn't just 100% safe
mm-hmm.
to do this. With every promoter, with every deal, and so, but they're litigating a whole lot of them, and a lot of times they come at them pretty hard and try and knock out the entire value at their starting point, which is
right. The first shot across the bow is all the deductions are denied.
No deduction at all.
Penalties.
Clearly, there's real property there.
Right.
You know what I'm saying? So there's got to be some value to it.
Right. Of course.
But regardless, that's where things are. There are a lot of cases, and they come out with a settlement initiative for that as well. Mm-hmm. That's the next article we're sending over to tax notes in the next week or so.
Right. Are these conservation easements, are they as broadly used as captives, more captives, or more conservation easements?
Oh gosh, that's really hard to say. I mean, I would say they're more captives, but they're just, I don't know how many investors are in all these conservation easements. There's billions of dollars that went into these things. So, I don't know how far and wide that spread. It's just a lot of people in each one of those things.
So it seems to me that the tax industry is manufacturing deductions. Would that be true?
Well,
taking advantage of what's in the code.
Taking advantage of the code.
I just had a question.
That's what we do.
Well, I'm not sure all the people know that that's what actually goes on, because I like what John said in one of our previous shows. There's one line, income is everything that you drive, and then there's 3,000 or more pages of all these deductions, credits. Go, and that's where all
that's what I do. I say, here, start off everything with the first code section, the mother of all code sections, and then you start explaining how you get around that definition.
Right. Yeah. I think that was section 61, at least it was when I was reading it a long time ago.
Still 61.
It's still out there, and then all of a sudden, here's all the deductions, credits, and that. Now the latest hot thing I've been seeing floating around is opportunity zones, which will be another subject of our Financial Friday, because I do have some people that work in that area. I just don't work in the area. And the other thing is, Professor Cantley, don't you find it interesting that this, if we talk about captives, we talk about conservation easements, there's a group of people in the United States and a group of people in the world that know a lot about that. But what about the average person in the United States? Do they really care about a captive or care about a conservation easement?
Well, the hope is on the captive front, because it's a long-term thing. Like, it's not a one-off deduction, right? I mean, you're creating an actual insurance company. You have to live with the regulation of that. And when you pay the premium, even if you get take the most aggressive position, which is that you claim a big deduction for something that's a very remote risk and you never have a claim, you still have a whole bunch of money trapped in an insurance company.
Right.
You have to pay them, keep it up and have it, deal with the regulators and compliance and everything else. And eventually the money has to come out, and that requires permission from the state authority or jurisdictional authority, et cetera. So that's a long-term thing. The conservation easements are different, right? That's something where people put in money and they get a deduction, and it's similar to how people do film credits or anything else, right? There are the very, very stable deductions out there for taking, for putting some piece of your money into it and getting a little bit bigger deduction out as an incentive from the IRS, from the code.
Mhm.
You know, so those are more one-offs.
Right.
You know, that's a whole different thing. I don't, and I'm, you know, what people, I don't think people were necessarily needed to know exactly what the value is based on, because it's being done by an independent third-party appraiser. That's what they need to read, and then try and figure out whether that's an accurate thing or not before they put it on their return. That's all they're really doing.
Right, right. But the thing is, captives, from what I understand, are used worldwide. As a matter of fact, Bermuda had a big captive reinsurance area, and also in the Caribbean, and that the whole purpose of this code wasn't 831B to bring captives back to the United States and have the funds held here rather than held abroad. Would that be the
I don't remember. I don't know. I don't remember the enactment policy. I can tell you that a lot of the encouragement for captives in the early 2000s was post 9/11, and I just think that there were just the government didn't want to be. It's the way I read it, the government didn't want to be the insurer of last resort, or with all these pools dried up. But I've never gone in and dug into the actual reason for enacting the incentive.
Mm-hmm.
Just one point, thinking about it, when Beckett made the comment, yes, there's a lot of captives that were, very aggressive, and it was kind of a nudge, nudge, wink, wink, say no more about what they were insuring. And the IRS has certainly been very aggressive at going after them. But the flip side is Congress has been very supportive. I think it was the 2017 Act that increased the 831B premium limit from 1.2 to 2.2 million. So, while they're looking at very aggressively the aggressive captives, there's a lot of support for the general idea.
Yeah, no, absolutely. And a lot of that came out of the farm state senators wanting to get that increased. I'm not quite sure what they're insuring down there, but there's also been a lot of encouragement for conservation easements. I mean, they made the accelerated deduction permanent on the one hand, at the same time that they're making it a listed transaction. So it's not like there isn't support for conservation and captives. And the other thing, John, that you're referencing overseas, and Nick, overseas, there are enormous amounts of money that go in and insure broad risks for companies and pooled interests where they don't even take the deduction. It's captives are kind of a fixed way, a part of the mortar of business these days. It's just not everybody takes the 831B, and eventually this will calm down and they'll kind of sort itself out, and we'll end up with the kind of more aggressive folks probably on the sidelines, and the more traditional folks not having to go through as much of this compliance risk that they're having to deal with right now.
Yeah. And what I see a lot of managers talking about now are really using it more as a way to still provide the risk insurance, but reduce captive or reduce the premiums or take advantage of margins. For example, from what I understand, workers' compensation, for example, is a very high margin insurance. So if you can insure that yourself, right, instead of paying those profits to the insurance company, you're retaining those. And so so there's very legitimate ways of using them.
Sure. Those and in workers' comp and situations like that can be a lot of times. So that's not something where you're that's a remote risk where you're valuing what you're putting in there. And so you're 100% correct. That's a good one. The other one, there's a lot of them have to do with warranties. At warranty programs where there's a lot of claims, and they're going to amalgamate a whole ton of them into one captive entity. Auto warranty, electronic warranties, things like that. There are a lot of different broad-based risks that can be done that way. There are also large, really serious risks that may or may not be insured outside of Lloyd's of London or something that you may want to set up a captive for. But you should, in those circumstances, generally, you're going to show that there has been a reason for that potential claim. There's been a loss or a real threatened loss, and it would have killed your business or something, and you need to get that thing insured.
Mm-hmm. Yeah, so there's legitimate reasons to actually have the captive, but if you do the captive wrong, it could be what they call a listed transaction. And if it's a listed transaction, don't you have a IRS form you have to fill out?
Yeah, it's a reportable transaction. The listed transaction is on the conservation easement side, but they have very similar reporting requirements.
Okay.
Both the advisors who make over a certain amount, and it's 50,000 or 100,000, depending on how it's what your role is and how many people you're dealing with and what the dollar amount is and all that. But regardless, the advisors themselves have to file a form saying they're a material advisor that on one of these transactions, and then the participants who took a benefit from it or were involved in the promotion or what have you, and have some kind of tax benefit from it, they're going to be filing. They have to file a self-reporting notice as well to the IRS, and it's pretty. The penalties are pretty heavy if you don't.
Mm-hmm. So if you're actually an advisor, so the financial advisors who listen to this program, if they are engaged in this listed transaction or this reportable transaction, they also have to fill out the form then in many cases?
Yeah, they have a separate form, but it's the same kind of information. Yeah, they're basically having to say, of course, there is a level of dollar compensation you have to receive for you to have to do it. It's not anybody who ever talked to anybody about a captive or something like that.
Mm-hmm.
But if you've made some money giving that advice and it's over the threshold, then you've got to report to the government that you've done so. This, by the way, does not mean that you're going to get hit with a promoter examination or anything like that. I mean, there's so much reporting at this point. And the IRS has gotten a whole lot better about sifting through it and figuring out, what's worth it, what's worth the time and what's not. So it's better to report than to not report.
Right. Well, the way I also understand it, you have to fill the form, but you also have to send the form to TIGA. You got to send it to 2 places. Is that what you have to do? And if you don't do it, then you haven't met the full reporting requirement. Would that be something correct?
Yeah, I can't remember whether you have to file more than one place. But whatever the requirements are, you got to fit them. It's just like reporting an offshore account. If you don't, it's hell and damnation, right? So just if you have it, if you've done that kind of advising and you've made a little bit of money on it, you need to go look at the threshold amounts. And if so, follow those, reporting rules really carefully.
Right. And then the thing is, what also bothered me, there was a case out of the Ninth Circuit, I believe it was May versus Commissioner. And they said that, well, if you didn't fill it out, and this was 15 years later, they went after the taxpayer 15 years later, said the statute of limitation continues to run. Now, it was a not published opinion, which means it's not viable in all the circuits, but could that be the case that if you'd never filled out the 8886 and you never reported to TIGA that, hey, you're still liable if they catch you, even if it's 15 years later?
The rationale, because you didn't file, there's no statute.
Failure to file, right? You got it, John, failure to file.
Well, I just recently read something where, on other items, not just that particular one, but they reserve the right to have no statute of limitations on certain forms if they're not presented at the time, even if you filled them out in the past and say, in 15 years, you kind of destroyed those, they can come back and ask for those forms. So there are some forms that they can ask for. 1045 is one of them for an NOL. So that is one of the things that they can come to you for, and there is no statute of limitations.
Yeah.
And
so this whole theory that you can destroy your forms after 6 years, that doesn't make any sense because they can go back.
Wow.
So they are using that against a lot of people, in particular for some reason. My research is showing me for some reason there's and I wish somebody could help me understand this. There's a focus on the years of 2007. So if people had a lot of NOLs being reported in 2007, that seems to be a time frame that they're going back to and saying, we want to see your 1045s. And people have destroyed their tax records from that time frame. It's been 14 plus years.
Right.
So, and they come back, and I went and looked, there is absolutely a law that says that that there is no statute of limitations. You will always have to show that 1045.
Yeah, well, I guess that means
they reserve the right to not.
well, I'm seeing a trend toward that. So shouldn't people, John, since you're a CPA, shouldn't people permanently, store the records electronically today because of this madness that happens with our friends at the IRS?
Probably a good idea. For a long time prior to most firms doing it electronically, the biggest thing is that you had a standard policy. You kept files for 7 years or 10 years or whatever, and then destroyed them. That was a reasonable policy. Today everybody stores everything's electronically,
right?
So it's certainly easy to do. Mm-hmm. I'd be interested in visiting with you about that, Kim, because the only time I've read about something like that is where it affects other years. So if you have an NOL and you're carrying forward some benefits, but certainly, the general rule is when the statute of limitations is closed, it's closed.
Right. Yeah. Well,
there is no statute of limitation. This is something I've learned about that. I would love to share this with you.
Privately,
Jim, I know, but I'm just saying that there is no statute of limitations. So yeah, privately, I will share some of this with you on the back end. But right. Yeah, Nick, we've got a guest sitting in backstage.
Oh, that's Michael. I know Michael. He's actually in New York. He's listening in because he's a financial planner, has been involved in quite a bit of captives. And a lot of the financial planners are very interested in these two programs that you're discussing, Professor Cantley, captives and conservation easements. Now, all these conservation easements deals are the same, and if they aren't, how do you distinguish between one conservation easement deal and another?
Well, they're for the most part they're structured the same, the way we discussed. So everyone takes a pro rata share of the easement after putting this pro rata share of the money in to the LLC. But there were so many different parties setting up these things, and they vary so widely in appraisal size, property is unique. So every single one of these things is going to be unique. I don't think you can do a one size fits all anything with them, other than to just look and see whether the deduction, matches up with reality. That's
right.
It.
Right.
I think that in the end, that's what most people consider, most CPAs and tax advisors back in Atlanta used to say about these things when they were proliferating, was that it all comes down to the appraisal. So you really need to take a look at comps and what have you, and that'd be your best way to assess it.
Right.
I think the promoters are the key there. Excuse me, Nick, but because I think there's a couple things. The valuation, as you said, that's been the primary focus of the Department of Justice, because there's really two probes at the conservation easements. It's the Department of Justice that issued subpoenas to promoters and appraisal firms, and then the IRS, which is looking at them obviously on examination. Valuations, as you mentioned, I've seen from 4 to 10 times valuations. When you start getting up 8, 9, 10 times, that's ridiculous. The other issue that I think that where they're at some risk is if you have a promoter that has never actually done anything other than do a conservation easement. Most of these are finalized right at the end of the year, and then the members vote on whether to develop the property or to put the easement on it. And if that all happens within a few days of the end of the year, and it always happens, that's a pretty good indication that you never had any intent to develop the property. Where some of I think what I would call better promoters actually do develop property from time to time, or a portion of the property. And you're seeing some of the programs I'm seeing now where they're taking a project and we're developing a portion of it, and we're only putting a conservation easement on apportionment. So your deduction is much less, but there's more economic substance to the project.
Yeah, that'd be a lot easier to get upheld, I would think.
Yeah, it's not as sexy, but it has more economic substance, and I think a better investment in the long term.
Yeah. So the IRS has a lot of these programs. It sounds like they're under audit. Is there going to be any settlement initiative? They actually had that, I think, even in the 412I or some of these abusive tax avoidance transactions. Is there a settlement initiative going on?
Yeah, there was one that was issued first for captives that's closed now. Of course, everybody's not necessarily sifted through whether they accepted it and finalized it, but they had to make an initial acceptance quite some time ago. And then there's a conservation easement one that has some difficulties. That's come out not too long ago. Again, we're publishing an article, my partner Jeff Dietrich and I, in Tax Notes in the next 2 or 3 weeks on that. But it has some issues about for it to be widely accepted because every single member of the LLC has to accept it, every single one of them. So if one of the taxpayers wants to fight it or just isn't going to deal with the terms of it, then the whole thing goes down, and that's going to make it much harder for the IRS to get a broad-based acceptance of it. It's also in both of these settlement initiatives, the fees and other things, which in captives can be pretty substantial, management fees, formation fees, that kind of thing. Those were not allowed to be deducted. So, they're costly. I still think if you're in with the wrong, easement group or with or captive management group, where you have a whole lot of IRS scrutiny, it's probably better to try to take a settlement than not. Just because the compliance cost and litigation cost is so outrageous.
Right.
And a lot of these people didn't take huge deductions, right? They took a reasonable size for their tax situation, but they were amalgamated into something that was large.
Right. So I'm going to just move off to a little other subject just because I'm curious since I have both you and John here. And this gone through my desk. I've seen it around, and it's called a restricted property trust. Has ever that floated in or out of your office, a restricted property trust?
Talking to me or John?
Either one. Have you ever seen restricted?
John, you ever seen one? I'm not familiar with that one.
Yeah, I've seen it. It's a twist on Section 79 insurance, which, as we talked about in a previous show, the IRS has always had some issues with abuse and perceived abuses in Section 79. The restricted property trust takes an approach where you have to fund the policy. You identify a charity at the time you enter into the policy, and you have to fund the policy for at least 5 years. If you fail to fund it, everything that's in the policy reverts to the charity. That's the restriction. And the feeling is that restriction has enough validity to the process that it avoids the other issues with Section 79. The tax advantage of it is you basically, let's say your business sets up the restricted property trust, you get a deduction for 100% of the premium that's paid. You, as the insured shareholder, pick up approximately 35% of his income. So it's a net 65% deduction.
Mm-hmm. Okay. All right. I just tend to stay in my own little narrow area of the world. So I read about all the other areas, but I go, gosh, if I never did a 419AF6 plan, had a lot of promoters come to me about it. And I said, look, I can't figure out how it works. I don't know if it doesn't work. When I get to that position, I go, I'm out. I don't want to do it.
And every one of them said that everybody else was doing it wrong.
Right. Everybody else said they're all doing it wrong. And I was going and I read through the code, I read through the regs, and I frankly, it was so, I couldn't figure it out. So I go, well, good for you. But I'm more than happy to stay in defined benefit, fully insured defined benefit, cash balance plans, all that. I'm perfectly happy. But when I get outside these worlds, it's quite interesting. So this year, should taxpayers consider doing a syndicated conservation easement, Professor Beckett Cantley?
I think, it's a listed transaction. So you have a decent shot of being looked at.
Yes.
Yeah.
Right.
It's right there in the crosshairs.
Yeah.
So,
Well, it's a listed transaction only if the valuation is more than 2.5 times. If the gift portion is more than 2.5 times,
But
your investment.
that's how the deduction matters, right? If it's not more than 2.5, then you're not really getting a tax benefit. You're getting a deduction that's kind of equal to what you put the money that you put in if you count it, adjust it for the tax rate.
Right.
All right. So it's a listed transaction if your valuation is higher.
Yeah.
Yeah.
Right. But then how do you ever determine that? See, one of the problems I have with this listed transaction, reportable transaction, at what point in time do you determine that it is a listed transaction? In other words, it's not a black and letter law that this is a listed transaction or this isn't. So who makes the determination it is, and the valuations that are not exist?
Well, they provide a description. I mean, they provide a description in the notice. So as John was referring to, it's more than 2.5 times. I think it is the amount of money you put in as a deduction. But if you like I was saying, if you work that backwards at 40% tax rate, 37% tax rate, whatever it is that you're using as a tool, as a marker, that comes out to being you have to have more than 2.5 times to have any actual tax benefit. So it describes that, and you're safer to report than, as we've discussed, leave it off just because you think it's well, I don't know, it doesn't seem to apply to me.
Okay.
Right?
All right. What about captive insurance companies? Are they also listed transactions?
Reportable transactions.
Or reportable transactions.
Has a similar reporting requirement.
Yeah.
So it's the same thing. Now that has more description in it, if you will, for what, because there, like I said, there's a huge captive insurance industry that has nothing to do with this, right? With the IRS crackdown. So, and they certainly do not want to stop everyone from doing captives, period. That's not the incentive. Okay. So there's a little more teeth on that one, a little more depth to whether it's a listed transaction.
Right. Now states have also competed, it looks like, for the captive insurance market. Utah has a captive insurance law. North Carolina had a nice captive insurance law. Florida has one for months, very popular. Do clients forum shop? Where are you going to set up the captive?
Sure. Well, there's good reason for that. I mean, and some states, Montana, there are a bunch of states that have really good regulatory folks involved. So, some places are just file the paperwork, and if the paperwork looks okay, it's fine. And others, they actually want to meet with you, and they want to sit down and figure out what your risks are. And so you can feel a lot more comfortable that the captive you're forming in one of those jurisdictions is probably being, doing what it's supposed to be doing, because they really won't let it get through, otherwise. So I do think they should, but not necessarily to race to the bottom, or like race to compliance.
Okay, right. So the thing is, then once you get your charter, then you can go ahead with basically the funding of the captive and writing the policies. But to me, if you're going to write the policies, Professor Cantley, isn't that a legal function for writing these captive insurance policies?
Well, it's both a legal and obviously an actuarial insurance question. I mean, you've got to have one person is balancing out what the risks are and what the value is, and the other is what are the legal terms in the policy itself, right? So both sides have to be cognizant that it has to be real insurance, and that's the fact that there are going to be no claims, or even if there are. They're like self-insurance, the way it comes back is that's troublesome to the service. So you want to make sure it's fitting right. That's for sure.
Right. Yeah. So, and when we contacted you last week, you were working on law review articles or papers that are going to get published. Can you tell us a little bit about the writings that you're doing in this area?
I've written and published law review. I don't know, like I said, 10, 20 law review and tax notes and other journal articles on captives. I'm only writing I'm writing 2 on conservation easements. One's on where the case law is going as a law review article, and the other is going to be tax notes on the settlement initiative. And what we do is we're putting a model taxpayer out there and putting them under 3 different circumstances in each scenario: captives or conservation easements. What happens if you never get audited, which is unlikely these days? get audited and take the settlement initiative, or get audited and don't take the settlement initiative and end up losing. So that people can make because a lot of people talk about what the terms are, but they don't put them into real numbers. So we thought it'd be nice to have someone have a real model to look at. We're a bunch of other articles that are completely unrelated topics out there. A lot of them had constitutional issues and taxation, but that's a subject for another show if we feel like doing it.
Yeah, because the thing is, I see these to be, pretty. In other words, when you have a client that has a lot of income, then what they grapple for is where to go for the tax deductions. But it sounds like, talking to you, if you run into the conservation easement, you're probably going into the headwinds of our friends at the IRS.
Oh,
But
yeah.
if you go to captive insurance companies, it looks like there's still a lot of play in the captives. Would that be a correct assessment?
Yeah, you still got an extra level of compliance, like I said, because you have to file forms, and you want to make sure you're not pooled. You take your risks and pooled with other people's risks. That's how insurance works. Don't want to be pooled with a broad-based promoters pool where there's especially where there's already IRS investigations ongoing, or they've been insuring things historically that that the IRS is really looking at, because you're just buying trouble. I mean, you're buying more compliance risk than you want. It's better to just kind of keep it clean. Work with other people in the risk pool that are thinking more compliantly than you are.
Mm-hmm. Okay, but before we close, I just want to know where people can reach you, because I always thought you're in Atlanta. Now you're in Las Vegas.
He's in Dallas.
You're in Dallas. Okay, so where in the world is
Dallas?
Beckett,
Well, our law firm has offices in Salt Lake City, in Las Vegas, in Atlanta, and in Dallas. But I was in Atlanta when I started, teaching, and I got remarried. My wife and I decided to move to Las Vegas, which we really love. And we were on our way out here visiting my partner, who is in Dallas. And COVID-19 hit, and I have a medical condition that means I can't get COVID-19. So we ended up renting a penthouse apartment here in Dallas and just parking ourselves and seeing anybody. Okay.
All right. So you really live in Las Vegas.
Yeah, in Las Vegas. Yeah.
You did live in Atlanta, and you're stuck in Dallas. Would that be correct?
We're buying a place in Florida too. Just so yeah, I'll probably split our time between Las Vegas and Florida. But we work. Our firm works nationwide. I mean, we'll get on a plane. So as soon as COVID-19 allows me to get on a plane, we'll get on a plane.
Yeah, COVID-19 stopped a lot of the planes. Where in Florida do you go to?
30A, right by Rosemary Beach, which is on the Panhandle.
Oh, you're on the Panhandle. Okay.
Yeah, there's a little stretch in between Destin and Pensacola that's kind of not been built up. Has just really nice little towns and beaches, and we like the remoteness of it, and just go out and play.
Very beautiful, very very white, beautiful beaches there.
Oh yeah, Dr. Beach says it's some of the best beaches in the world are on the Panhandle of Florida. A lot of people have just never been there, but they really are spectacular. Do you live in Las Vegas, or do you live in Henderson?
No, Las Vegas.
Actually, live in Las Vegas.
Yeah.
Okay. Live on the Strip. Wow.
Yeah. We like to. Well, we think about it. We go and play on the beach, and then we go out to the casinos and go see shows and stuff.
Well, I was going to say you can see a lot of shows. Some of the best shows are in Las Vegas. So, anyway, we're at the hour. I'd like to thank our special guest, Professor Beckett Cantley, from Dallas, Las Vegas, Florida, places in between. You can catch with the frequent flyer miles. John Power, CPA from Bismarck, North Dakota. He's more stable. Every time he comes into one city, Bismarck, North Dakota, so we know where he's at. Kim Calhoun, one of our executive directors at IBM TV, and certainly thank you for the audience for attending. And Kim, you know how to press all the buttons, so you can press the ending.
We're going to take off now.
We're going to take off.
And that's a wrap.
Okay.